My name is David Berkowitz, the Chief Investment Officer of Value Line Partners. In this video, I'm going to talk about what it means to be a value investor. In the beginning, there was the idea of investment, straightforward, unconstrained investment, whose goal was to maximize long-term after-tax returns, period. It was a simpler, happier time when the essence of investment was to seek out value, to buy what was cheap with a margin of safety. Investors could go from bonds to stocks as they saw fit. If prices were too high, then investors held cash. Then in the 50s, a young researcher at the Rand Corporation was figuring out how much of his retirement money to allocate to stocks and how much to bonds. An expert in linear programming, Harry M. Markowitz, described his solution in a scholarly article called Portfolio Selection for the Journal of Finance, purportedly showing exactly how to calculate the trade-off between risk and return in portfolio construction. Modern finance theory was born. Eventually, banks, investors, corporate managers, government policymakers, consultants, trust companies, family offices, hedge funds, fund of funds, and even central banks adopted this modern finance theory, where a bunch of experts modeled the world the way they thought it ought to look. This model started with the observation that stock price movements were random and could not be predicted on the basis of past movements. This was followed by the efficient market theory, or EMH, the claim that it was impossible to predict stock prices on the basis of any publicly available information such as earnings reports, balance sheet data, and articles in the newspaper. EMH led to the conviction that stock prices were in some fundamental sense correct. That is, stock price equals value. It was a powerful idea, helping to inspire the first index funds, modern portfolio theory, risk-adjusted performance measures that shape the money management business today, the rise of derivatives, and the hands-off approach to financial regulation that prevailed in the United States from the 1970s on. The lesson was that the market knew more than any person or central bank did. The market was right. And then suddenly, Lehman collapsed, and the market wasn't right anymore. The private market for U.S. mortgage securities cratered, beginning an unraveling of stock and bond markets around the world. Surely price and value were not the same all the time. It's clear that after the financial panic of 2008, investing needed to get back to its roots in the garden of value investing. The best place to start is in the beginning with Ben Graham, the founding father of value investing. He said, "Investment is most prudent when it is most businesslike." Unfortunately, most investors give more attention to stock market price swings than to what the underlying businesses are doing. The value approach looks for investments at sensible prices to think first about the business and its industry. It views stocks as little pieces of a whole business, and the goal is to determine whether that business is undervalued, fairly valued, or overvalued. A systematic, business-like approach to investing. To the value investor, in the short term, the stock market is nothing more than a voting machine that determines the prices of shares by popular vote every minute of every trading day. These prices change much, much more than the values of the underlying businesses do. But in the long run, the market is a weighing machine where eventually intrinsic value and price converge. The stock market is merely the place to buy ownership shares in undervalued companies or to sell shares at fairly valued prices. At the very heart of value investing is the belief that the price paid for an investment drives the likely return. A stock can be a good investment at one price, but not at another price. This approach inherently rejects modern financial theory in which price and value are equal. As Warren Buffett quotes Ben Graham as saying, "Price is what you pay, value is what you get." Also, value investors define risk much differently than the academics and modern finance adherents. They define risk using the dictionary, which says risk is the possibility of loss or injury. Owners of businesses define risk the same way. And as owners of shares of those businesses, value investors do too. Proponents of modern finance theory define risk much, much differently. For them, risk is the relative volatility of a stock or portfolio of stocks. A precise mathematical measure of risk called standard deviation, defined by sigma or beta. These precise measures obscure the real idea of risk. That is, the possibility of losing money. Therefore, most advisors and investors think the stock market is quote-unquote risky, where they really mean quote-unquote volatile. It goes up and down a lot in the short term. So they put too little of their savings in stocks because they cannot bear the pain of watching the value of their savings go up and down in the short term. Why do they care if they don't sell anyway? Value investors like stock market volatility. They embrace it because it is the necessary condition for the higher returns on stocks. Plus, they purchase investments with a margin of safety, a discount to their conservative estimate of intrinsic value. They know that any estimate of intrinsic value will only prove to be correct due to luck. So they buy only when a large discount to that estimate is available in the market because it offers protection against being wrong. As Ben Graham taught, the margin of safety is available for absorbing the effect of miscalculations. Value investing is safety-first investing. It places risk management at the very heart of the process. In summary, value investing is the belief that the price we pay for an investment determines its likely return, and that price does not equal value. Value investors think of risk as a permanent loss of capital, not volatility, as do the academic finance quants. And value investors know that any estimate of intrinsic value will only prove to be correct due to luck. Therefore, buying only when a large discount to that estimate or a margin of safety is available offers protection against being wrong. And that's it. Value investing gets us back to the time when investing was simple, straightforward, and unconstrained, when the goal was to maximize long-term after-tax returns, period. Thank you for listening.